You can execute a digital stock trade in a fraction of a second. Establishing a position in real estate requires weeks of heavy physical labor. That physical reality imposes strict constraints on the asset. Real estate is completely immobile, tied entirely to its local economy, and it is heterogeneous. There are no two identical properties. These constraints create massive friction. Unlike equities, which trade in high-volume, liquid markets, a physical property is highly illiquid. It requires a long selling period and heavy transaction costs just to change hands. Yet, because of these very constraints, real estate operates as a powerful hybrid asset. It generates recurring income like a bond, achieves capital growth just like a stock, and acts as a tangible store of value like a commodity. You cannot evaluate a friction-heavy hybrid asset with a single metric. Measuring its true performance requires a multidimensional mathematical framework. This equation on screen is the definitive formula for evaluating real estate wealth: total return. It isolates 4 specific variables: income, appreciation, leverage, and tax. Beneath these columns, we have mapped a standard investment timeline. We are going to track a case study, a 5 million peso property purchase that yields a final 4 million peso total return over exactly 5 years. To find where that 4 million actually came from, we need to map the 4 variables chronologically across the life cycle stages of the property. A basic return on investment calculation misses the mechanics of how this money is made. Real estate wealth is a chronologically stacked equation built over time. Looking at year 0, we start with the entry phase. The objective is securing a buying advantage. However, entering the market triggers friction costs, capital gains tax, documentary stamp tax, and transfer taxes, creating an immediate drag on deployed capital. To offset this heavy capital requirement, investors rely on the L in our framework: leverage. Debt financing allows an investor to deploy a small initial equity baseline, say 1 million pesos, to control the full 5 million peso asset. This structure alters the math. If property value increases by 10%, your gain is calculated against the total 5 million peso asset, not your initial 1 million. The yield is magnified, though it works the exact same way for potential losses. The entry phase establishes your mathematical baseline. Leverage acts as a multiplier, but high transaction costs drag on initial liquidity. Advancing to years 1 through 4, we enter the holding phase, driven by I for income. Professional investors measure this using net operating income, or NOI, calculated by taking gross income and subtracting vacancy losses and operating expenses. Gross rent assumes perfect conditions. Subtracting realistic vacancy rates and maintenance costs gives you the actual stable cash flow the asset generates. Over our 5-year timeline, this recurring NOI produces exactly 2 million pesos. That is half of our target case study return. During this phase, investors track their cash-on-cash return. It's a ratio that measures the actual annual pre-tax cash flow against the exact amount of leveraged equity invested in year 0. Properly calculated NOI provides predictable liquidity. It forms the stable, recurring mathematical basis for the asset's intrinsic valuation. Notice the line graph rising steadily underneath the asset throughout the entire holding phase. This is the A variable, appreciation. There are 2 distinct mechanisms for capital gain: natural and forced. Natural appreciation relies entirely on market drivers, primarily urbanization and the expansion of infrastructure into new geographic zones. In the Philippines, major state-backed infrastructure projects physically connect rural zones to urban centers. This rapidly pushes up provincial land values in areas like Cavite through pure market demand. Forced appreciation requires direct capital to actively optimize the asset through major physical renovations, rezoning for commercial use, or redeveloping to its highest use. Reaching that future value of 7 million pesos requires active optimization. Appreciation is a structural shift in property utility and location, not a passive guarantee. We arrived at year 5, the exit stage. This is where the paper gains, our remaining 2 million pesos in appreciation, are finally realized through a sale. But the gross return is an illusion. You must factor in the final variable, T, for tax. The Philippine tax code makes a critical legal distinction based on use. Selling a residential capital asset triggers a 6% capital gains tax. However, selling an ordinary asset used for business triggers corporate income tax plus a creditable withholding tax, altering net return. To defend the yield, investors use specific tax strategies, such as claiming depreciation on ordinary assets and utilizing interest deductions during the holding phase. Sophisticated tax strategy reduces the net cost of the asset over its lifespan. Efficiently structuring the tax variable mathematically increases the real finalized return. But there is a flaw in treating this gross number as face value. Due to the time value of money, capital earned in year 5 is mathematically worth less than capital spent in year 0. Professional investors use the internal rate of return, or IRR, to measure time-adjusted return, factoring chronological delays into actual profit. We also apply net present value, or NPV, discounting all future rent checks and the final sale price back to their worth today. IRR and NPV translate a messy, multi-year chronological narrative into a precise binary decision for today: accept or reject. Stepping back from the specific model, we can see how these principles govern the broader market. Real estate returns are strictly multi-sourced, inherently time-based, and highly strategy-driven. To audit any property, look at this checklist on screen and ask 4 questions. Where is the income coming from? What drives the value increase? How is the financing structured? And what taxes apply? If you can answer those 4, you understand the mechanics of the investment. Mastering the IALT framework is what transitions an individual from being a passive capital provider to an active creator of wealth.